The Federal Reserve in turmoil. Wall Street warns that undermining its independence will inevitably destabilize markets. What does this mean for everyday Americans? Apples. The Fed is about to be shaken up. Wall Street warns that if the Federal Reserve loses its independence, market stability will no longer exist. Or stocks, mortgages, inflation, everything could be overturned and started over. The most critical question is, what should ordinary people do? Hello friends, I'm Owen, a professional investor with over 10 years of experience specializing in U.S. stock investments. Before we start, don't forget to like this video and subscribe to my channel. Your support is my greatest motivation to update every day. Today, the three major US stock indices opened lower but climbed higher by the close. After a brief cooldown yesterday, market sentiment has rebounded again today. Analysis. We were still discussing Trump's political pressure on Federal Reserve Governor Lisa Cook. But just yesterday, this controversy escalated sharply, evolving into an unprecedented power struggle. Trump is no longer satisfied with making statements from afar. He has formally taken action to try to remove Lisa Cook, one of the 7 Fed governors. A fundamental shift in the nature of the event from political pressure to a real legal and power confrontation. Just last night, Trump posted an open letter on social media announcing his decision, citing previous allegations of mortgage fraud involving Cook. He decided to fire her and claimed he had full justification to do so. This move has never happened before in U.S. history and directly strikes at the foundation of the Fed's independence. Facing the president's dismissal order, Lisa Cook did not back down. She immediately issued a statement through her lawyers, firmly responding that Trump has no such authority and that she would never resign. More importantly, her lawyers said they would immediately file a lawsuit to challenge the president's illegal action. This back and forth has transformed the conflict between the president and the Fed governor from a political storm into an open legal battle. On a deeper level, this showdown reflects Trump's ambition to directly control the Federal Reserve. If this struggle continues to escalate, it will not only impact the U.S. dollar and treasury markets, but could also change the market's pricing logic for interest rates and risk. What convinces the market that inflation risks will be controlled is trust in the Federal Reserve's independence. But once the Fed loses that independence, market will start to doubt whether the Fed will still act decisively to raise interest rates to curb inflation when it arrives, just as it has in the past. Market believes the answer is no. Concerns about uncontrolled inflation will rise sharply. The result is that investors demand a higher risk premium to compensate for potential inflation losses, causing long-term treasury yields to rise instead. If you agree with my analysis, don't forget to like this video, subscribe to my channel, and share your thoughts in the comments. The core of this showdown is not simply about rate cuts, it's about the assault on the Fed's independence. Ultimately, this assault will be transmitted through changes in long-term interest rates, leading to a differentiated impact across stock market sectors. More growth-oriented tech stocks, their high valuations heavily rely on a stable interest rate environment over the long term because their value mainly comes from future cash flows. Rising long-term rates directly increase the discount rate, thereby lowering the present value of those future cash flows and putting heavy pressure on their stock prices. In contrast, mature cash cow companies tend to fare better. These companies usually have stable businesses and steady cash flows, which give them a certain degree of resilience. For them, the impact of rising long-term rates is much smaller. What convinces the market that inflation risks will be controlled is trust in the Federal Reserve's independence. But once the Fed loses that independence, market will start to doubt whether the Fed will still act decisively to raise interest rates to curb inflation when it arrives, just as it has in the past. Market believes the answer is no. Concerns about uncontrolled inflation will rise sharply. The result is that investors demand a higher risk premium to compensate for potential inflation losses, causing long-term treasury yields to rise instead. If you agree with my analysis, don't forget to like this video, subscribe to my channel, and share your thoughts in the comments. The core of this showdown is not simply about rate cuts, it's about the assault on the Fed's independence. Ultimately, this assault will be transmitted through changes in long-term interest rates, leading to a differentiated impact across stock market sectors. More growth-oriented tech stocks, their high valuations heavily rely on a stable interest rate environment over the long term because their value mainly comes from future cash flows. Rising long-term rates directly increase the discount rate, thereby lowering the present value of those future cash flows and putting heavy pressure on their stock prices. In contrast, mature cash cow companies tend to fare better. These companies usually have stable businesses and steady cash flows, which give them a certain degree of resilience. For them, the impact of rising long-term rates is much smaller. bubble. To better understand this, let's compare with history. During the 2000 dot-com bubble, margin debt was $278.5 billion. During the 2008 subprime crisis, margin debt was $381.4 billion. Today's $1 trillion is roughly 3 times the level seen in those crisis periods. Such a scale cannot be ignored. Does it represent accumulating risk, or has the market entered a whole new phase? This is a question we must seriously consider. This, in turn, can trigger even larger scale sell price, driving stock prices further down and ultimately creating a vicious cycle. Historically, rapid spikes in margin debt have often occurred right before market peaks. For example, during the dot-com bubble and the financial crisis, margin levels reached their highest points just before the crashes. However, an article from the Wall Street Journal offers a counterintuitive yet easily overlooked perspective. The article points out that the surge in margin debt is not solely due to investors actively levering up markets, and there is another key driver, the market's own rise. How does this work? Why would a rising stock market push margin debt higher? The article explains that margin debt is used not only for long positions but also for short selling. And when investors short stocks, they need to provide collateral to brokers. As stock prices rise, they must add more collateral, which often gets automatically transferred through margin accounts. The result is that the faster the stock prices climb, the more margin debt is passively pushed up. From this viewpoint, the record high margin debt is more a consequence of the market's rise rather than a predictor of its next move. So if margin debt data is neither a bubble signal nor a reason for the market's rise, what does it really indicate? The article goes on to say that this data actually reveals one fact: it's the best time for brokers and investment banks. For companies like Charles Schwab, Interactive Brokers, and even Goldman Sachs and Morgan Stanley. Margin debt borrowed by investors represents an extremely lucrative source of interest income. For example, in Q2 this year, margin lending at Charles Schwab and Interactive Brokers grew by over 15% year during the post-pandemic recovery phase. This business even surged by 90%. However, there is another side to the story. Model is a double-edged sword because brokers and investment banks' performance is highly tied to overall market movements, which also amplifies their stock price volatility. In a bull market, the stock prices of these companies often outperform the S&P 500 by a wide margin. But once the market turns downward, investors' borrowing demand quickly shrinks. The collateral required for short positions decreases, and brokers' interest income naturally drops significantly. At that point, the share prices of these companies may fall even faster than the broader market. I believe that while the Wall Street Journal's article reveals an important margin factor, it oversimplifies the issue and somewhat downplays key points. Attributing the trillions of dollars growth in margin debt mainly to short sellers adding collateral is not a rigorous argument. In a continuously rising market, short positions typically shrink rather than expand. Many short sellers have already been forced to cover and exit, meaning brokers do not gain extra margin income from them. Beyond this logical flaw, I think a more reasonable angle is to consider the margin debt to market capitalization ratio. Let's compare historical data. At the peak of the 2000 dot-com bubble, margin debt was about 1.6% of total market cap. During the 2008 subprime crisis, it was around 1.94%. At the previous peak in 2015, it was about 2.19%. Currently, this ratio stands at only 1.62%. In other words, today's margin debt ratio is not in a dangerous zone. So rather than focusing on a single data point, investors should return to the fundamentals of investing, macro policy trends, technological developments, and company fundamentals. These may seem dry, but they truly determine long-term stock performance. Of course, sound investment discipline is equally essential. Speaking of investor focus, tomorrow, the global capital markets will once again turn their attention to one name, NVIDIA. The company is about to release its Q2 fiscal year 2026 earnings report, which could be the most important event for the market since the central bank annual meetings. After another quarter of remarkable growth, can this AI giant deliver another earnings beat? What exactly is the market most concerned about? Which business segments and financial metrics will be key to NVIDIA's stock price direction? Before we dive into the outlook, let's quickly recap. Last quarter, in May, NVIDIA reported its Q1 earnings with revenue, operating profit, and EPS all beating market expectations, once again demonstrating the company's absolute dominance in the AI space. So will the story continue this time? Feel free to share your thoughts in the comments. Do you think NVIDIA can keep beating expectations? Markets frenzy already priced in too much for the future. I view The real focus of NVIDIA's earnings tomorrow isn't really on the usual numbers, like revenue or operating profit. A flash from past experience. NVIDIA's guidance tends to be conservative, so beating expectations isn't that difficult, especially given that AI demand remains strong with no signs of slowing. The surprise factor on these routine metrics might be limited. So where's the real emphasis? I see two key points. First, gross margin. Gross margin is a critical indicator of a tech company's product pricing power. NVIDIA stock stabilized and rebounded, mainly because of the successful launch of its Blackwell GPU bucket, which caused a notable margin improvement. The market now expects Blackwell to continue driving margin gains. Margins falter. Even strong revenue and profit numbers might not prevent downward pressure on the stock. Second, product iteration. You might remember that last year, NVIDIA's stock struggled mainly because there was a gap between product cycles about disrupted supply and demand timing. The big question now is, will that happen again this year? There were rumors that NVIDIA's next-gen chip, codenamed Robin, might be delayed due to competition from AMD. Though the company denied this, tomorrow's earnings call will likely see investors focusing closely on the progress of Robin's development, making it a critical risk and key point to watch. To sum up, tomorrow's earnings won't just be about revenue and profit. Watch these two things closely. Can gross margin keep climbing, and can Robin chip development proceed smoothly? These factors could well determine how NVIDIA's stock moves after the report. If you're following NVIDIA or want the latest in-depth analysis of U.S.tech stocks, drop a comment below with your take. Will NVIDIA's stock rise or fall after this earnings? I'll bring you a detailed breakdown as soon as the report is out. That's all for today's video. If you found it helpful, please like, comment, and subscribe. I'm on, and I'll see you in the next video.